Welcome to this ACA Masters lesson. My name's Ben Roberts, and this lesson will be looking at corporation tax. As we said previously, corporation tax is the tax that limited companies will be paying. So remember your different types of business structure. So we'll just have a very quick recap here, where a limited company is a separate legal entity, separate from the owners, the shareholders, and just completely different to sole traders and partnerships who, of course, pay income tax. So that's kind of the first thing to remember. Corporation tax is for companies. Now, of course, just like individuals, companies can have various different types of income. Now, the big difference, though, I suppose, between an individual and an incorporated business is that the corporated business is going to just incur tax at 19%. Corporation tax is like a flat rate of tax. Doesn't matter the type of income, it's all going to be taxed under corporation tax at 19%. So, completely different to what we saw before for those income tax questions for individuals. We had like different basic rate band, higher rate band, different rules for dividends, savings and trading and non-savings income. So that's one of the key things to kind of remember as well. So wherever you kind of get asked what's the corporation tax liability, it's always going to be whatever that profit was times by 19%, except dividends. Dividends are just exempt for corporation tax. That's another thing to just learn. Now, although everything gets taxed at 19%, we still need to, like I was saying, calculate and determine the types of income that the company has generated in that period. So although it all gets taxed at the single rate of corporation tax, we still need to know what was their trading income, what was their property income, what was their, and it's called non-trade loan relationships, but essentially that's their kind of savings income. And we'll come on to this in more detail later, but essentially it's kind of like their interest receivable less their interest payable. That's specifically, of course, for non-trading reasons. And we'll come on to that at a later point in this class, as well as then the chargeable gains. So again, individuals pay capital gains tax on their capital disposals. And we've obviously discussed that in a separate lesson, whereas companies are going to pay corporation tax on their chargeable gains. And again, we'll look at chargeable gains for companies in more detail later on in this class. So kind of, and this corporation tax pro forma here that's in front of us now, this is kind of like what you need to do on those scenario questions for corporation tax. You'll kind of be given some information about a company. You'll be given a few different types of income, and it's going to be kind of your job again on exam day to populate those questions with the different types of income. So what's going to be the total that goes into each box? And of course, your trading income is going to have the most amount of workings, but the other ones will have some things to do. So like I was saying, though, the kind of the really good news for corporation tax is kind of how we arrive at our tax adjusted trading profit is nearly identical to what we saw for individuals and income tax. So it's kind of, and it does kind of make sense. There's no kind of beneficial business structure to set up as to kind of get a favorable set of rules or something like that. They are very much the same. And it's kind of like, I suppose if you just think of a very basic example, like a garage that's set up as a sole trader or a garage that's set up as Garage Limited, both of those two things are going to be doing the same trade. They're going to be fixing and mending cars for customers. It doesn't matter that one's a sole trader, one's a limited company. It doesn't really make much difference to the actual trade of the business. The one's just got this separate legal entity, and that's why there's no real major differences. Now, there are some quite specific differences, though, and one key one, and they do tend to throw this in quite a lot in the questions to really examine you, is that, of course, when we looked at individuals and there was anything to do with kind of private use of assets, we took that on board in the questions, and we restricted any kind of capital allowance, any kind of cost that were in relation to them privately. We wouldn't kind of deem that an allowable cost, and we'd make an adjustment for that, because essentially that individual is the business. there's no kind of separate legal entity where they're a sole trader. So if they're using, let's say, a car privately, they can't have the full cost of that car going through their business. So where this is different, though, for corporation tax purposes is, of course, when we're looking at corporation tax is going to have a separate legal entity, the company. And the company is the one that owns all the assets and liabilities of the trade. And it's the company is the legal entity, or the one that is going to purchase the car or have all the different expenditure going through the company. Now, of course, if you kind of consider a company, and I think a car is a very good example, a company can't get into that car and drive it and use it in a personal or private capacity. It's just impossible. A company isn't an actual kind of tangible legal person or thing. It is just a separate legal entity. So therefore, when you see in the corporation tax questions anything in relation to private use of directors or employees using anything, whether that be a car, any form of expenditure, if you see anything to do with a corporation tax question and those private aspects, you essentially ignore it and you do not restrict any of the costs, because essentially, and the way of thinking about this is, the company itself has incurred the cost in full to essentially, remunerate and to pay its staff potentially. It's kind of the employee's issue if the employee is then using that car potentially in a private capacity or using costs in a private capacity, but the company would never get the cost of those items restricted for private use. And that probably is the main fundamental kind of examinable point that kind of does come up quite a lot in the question bank. So, again, if you were kind of not feeling very confident on that trading income, set of rules, just really make sure you kind of spend some time now to kind of learn all of these and what's your disallowable costs and what's your allowable costs, so that essentially you can kind of be able to read these exam questions and essentially know exactly what to do with each point that comes up. Now, of course, what I was saying before is we're going to need to essentially work out, different types of income. And therefore, what we'll do now is we'll just work through quite a simple example, which will cover the various different things that we need to do in going from an accounting profit to a taxable profit. This is going to kind of, like we were saying, this is going to really kind of mirror what we saw before for trading income. So here we've got, our accounting profits for the company. So X Limited, they have their revenue, cost of sales, various different costs, got some dividend income to arrive at the moment our profit before tax. Now, what we need to kind of do, and this is kind of mirroring those scenario questions really, is we need to understand, okay, well, what is trading income? What's property? What's non-trade loan? What's gains and dividends and qualifying charitable donations, to get to what's known as our total taxable profit, which is essentially all of the streams of income. And then it's that total taxable profit that is charged at 19% to get the company's tax liability. So the first thing, obviously, I've kind of put down some various different costs there, but the first one, and you probably will see this in most exam questions, is depreciation. So like what we saw before, depreciation is always a disallowed cost. Depreciation, disallowed cost, it's always added back. And the reason it's always added back is because depreciation is replaced by capital allowances. So what you're going to have here is you're going to have, in terms of going from our accounting profit to our taxable profit, we're going to have an add back of the depreciation. Now, we'll come on to the capital allowances when we get to the end of all the different costs that have gone through for this company. But that's one of those key kind of basic rules to just remember, because it does tend to come up quite a lot in the questions, but it's not really worth a huge amount of marks. But you're always going to add back that depreciation. Now, the next one is wages that we can see. So where, of course, and this is probably the other kind of subtle difference between individuals for income tax and corporation tax is, of course, an individual, we could have seen that they paid themselves a salary and we deemed that profit appropriation, and we said, well, this is not going to be an allowable cost for tax purposes, we'll add it back. Now, a company, is never going to kind of pay itself a wage, or it's never going to pay itself a salary. Instead, what a company will do is pay its shareholders a dividend. So in exactly the same way as a sole trader can't pay themselves a salary and have that cost as a deduction against their trading profits, exactly the same way companies cannot have a deduction against their trading profits for a dividend that they pay over to their shareholders. So what we could potentially have here, as well as dividend income, we could have a dividend expense to the shareholders of, let's say, deduction of 50. If that were to be there, that would be a disallowed cost for tax purposes. But that's not a hugely common exam area, to be fair. It's just something to really know and to be aware that there is a kind of an overlap of the rules and a similarity in the rules. It's just, again, going back to those legal entities and the fact that there is now that company, that separate legal entity that, of course, has shareholders, and therefore, rather than, of course, paying a salary to yourself like a sole trader, it's the company that's going to pay the shareholders the dividends, and that's going to be disallowed for tax purposes. Now, similarly, like rental costs, that's just going to be an allowable deduction. But what is going to be quite important here is, of course, we've got property income. Now, property income isn't part of, and we'll assume that this business doesn't kind of trade as like a commercial letting company or something like that. So the property income isn't going to form part of their trading income. So what we need to do in this setting is, okay, this is property income. It's increasing, obviously, our profit before tax and our financial statements. So the first thing we need to do in terms of arriving at our taxable trading profits is to remove that property income. So we're going to have a negative here. Now, importantly, we're not saying kind of, this property income doesn't get taxed. We're just saying that this property income is not going to form part of the trading income, because this, when we arrive at the final taxable trading profit, that number will go in here. So what we're saying is, well, this property income isn't part of our trading income. It's actually property income, and it should go in a separate box on the corporation tax pro forma. So it's kind of, we're basically moving it from the trading income to the property income box because it's not part of their trading income. It's just like quite an important kind of mechanism that you'll see in these sorts of corporation tax questions, where we're kind of moving amounts from trading to other boxes on the pro forma. Now, very similarly, what we can see is, of course, we've got a profit on disposal. Now, again, if it's a profit on disposal, that's going to be a chargeable gain. Now, the first thing we do for a profit on disposal is very similar to property income. We're going to remove that profit on disposal. And again, we just need to work out, well, what is our chargeable gain? Now, the chargeable gains are worked out identically to the capital gains tax for an individual. So we're going to compare our proceeds, less the cost of the asset, less any allowable deductions. But quite importantly, the clear distinction and the difference is that the company doesn't get the annual exemption. So, of course, in this setting, we could have had maybe, they actually sold it for 90 and the cost of the asset was, let's say, kind of 70 to get our actual chargeable gain on disposal of 20. Now, remember, the number that's gone through our financial statements is kind of the accounting profit on disposal. So there we would have kind of compared the proceeds to the net book value and then worked out, actually, okay, well, what is that profit on disposal? Whereas the chargeable gain is going to be worked out purely on, okay, well, what are the proceeds? The cost of the asset was this, and then that is, and we might have had kind of, maybe allowable costs of 20 or whatever kind of came up in the question to get to our chargeable gain. So again, very similar to what we've seen before for property income, that profit on disposal, it's not part of the trading income. So it's not going to stay in that profit, in that trading income, and where it's going to go is in that box. And importantly, the number that goes in that box is the actual chargeable gain. So whatever you've worked out, the proceeds less the asset cost, less the allowable cost, that's going to then be your actual chargeable gain. And of course, the questions will always give you the information to work out the chargeable gain, or indeed sometimes they just give you okay, well, this is the chargeable gain the company made on the disposal. So the next one we've got is charitable donations. So everything for corporation tax is handled on an accruals basis, except for, very importantly, qualifying charitable donations. So what this means is, and if you kind of cast your mind back to kind of how you prepare your set of financial statements, is you're going to essentially apply the accrual basis. You're going to match kind of revenue and cost to when they fall due rather than when the cash was paid. Now, this is what we do for everything else on corporation tax. So, like that property income, we would have applied that on an accrual basis, and we would have kind of not completely disregarded the cash, but yeah, we would have kind of worked out, okay, well, what property income was due for that period, and then we would have put that into our pro forma. Now, the charitable donations are different. So the charitable donations have their own separate box on the corporation tax pro forma. So the first thing, again, what we're going to do, because they go in somewhere separate, we need to remove them from our trading profits. So of course, they were a cost. They previously kind of reduced our accounting profit. So what we need to have here is an add back, firstly, of the charitable donation. Now, really, really importantly, the rule for charitable donations is essentially it's on a cash basis. Now, what that means is that, you only get kind of a deduction for the cash paid. So what you couldn't kind of do is accrue for like a massive donation and reduce your profits. You only get the deduction where you actually have paid that cash. So it could be that, that 50 was made up of, I don't know, like 40 K that was accrued, but only 10K was paid. So what you would then have, the qualifying donation, is the 10 that was paid. That's going to be our qualifying donation. That's going to be an allowable deduction against our corporation tax total profits. Now, in the next period, it's not kind of like you don't get any relief for that 40 that was accrued. Of course, in the next year, assuming you actually go ahead and pay that charitable donation, in the next year when they do pay that donation, they'll get the deduction of 40 in the next period. Of course, in this example, we said they've only paid 10, so they're only going to get a deduction of 10 against their total taxable profits. So then dividends, the next, and this is one rule, like I've said already, that you just need to remember, where dividends are exempt from corporation tax. So the dividends, of course, were income. They've increased the profit before. So again, we're going to have a negative. We're going to remove them from our taxable profits. And of course, really importantly though, we're going to put a zero, because dividend income is exempt from corporation tax, as we've seen before. So that's just a really important rule, and hopefully if you kind of learn and remember that rule, that will allow you to score quite a couple of easy kind of half marks on exam day, because you're going to be removing the dividend income from your taxable trading profit working, and then you're going to be putting a zero up in your corporation tax pro forma. Then we move on to interest receivable and interest payable. So with interest receivable and interest payable, there's kind of two buckets, as it were, that those types of things could fall into. They could either be non-trade, so they could either have nothing to do with your trade, or they could be trade related. And this is where we get to the idea of a non-trade loan relationship. So if we start with interest receivable, this is quite a nice one, because essentially, like any interest receivable really, it's quite rare actually in the scenario questions to have kind of trading interest receivable. You'd have to be kind of like a bank or a financial institution, which I don't think you're going to see in the questions. So essentially what you can kind of safely assume is where you get interest receivable, that's just all going to be non-trade loan relationship. Kind of if you think about the garage example we were talking about earlier, if that garage is kind of a saver of money and they've got a load of money saved in their bank account and they're just getting some interest return on that savings income, that's not going to be part of their trade, but it's still income for the business. So how we account for that on corporation tax is we're going to put that to our non-trade loan relationships. So very similar to all the other types of income that need to go somewhere else, we're going to have a negative here for the interest receivable, and then that 10 is going to be added to our non-trade loan relationships as income because it's interest receivable. Now, interest payable is probably one where, you just need to kind of learn the different types of examples, because this is where you will see kind of a split between, is this non-trade or is this trading loan relationships? So the workbook does have a really good little section on this, and I'd strongly suggest having a read up. I've kind of summarized it very briefly here, but essentially it kind of all stems back to that key thing is this interest cost that we've incurred as a business linked to our trade, or is it actually not linked to our trade? If it's linked to our trade and relevant for our trade, what that's going to mean is that interest cost, if it's linked to a trading loan relationship, i.e., the interest we've suffered is in relation to our trade, it's going to be like a cost that's going to be allowed to be offset against our trading income. So if this interest payable was all in relation to, a loan to buy plant and machinery that we use for our business, we wouldn't have any adjustment because it's been reduced against our accounting profit, and we're saying it's a trading loan relationship, so we wouldn't need to do anything. Now, if it was actually that this interest that we've incurred wasn't actually in relation to our trade, and this is the interest on a loan for that investment, what we would then say is, well, this is non-trade, it's not linked to the business trade, so we can't have it kind of offsetting against our trading box. So what we would need to do for that interest payable is we would have an add back of 30, because we're saying it's not linked to our trade. We can't have it as a deduction against the trading income. And therefore, what we would need to do is allocate that cost, the interest payable, to our non-trade loan relationships. So essentially, we had income previously of 10, so the interest receivable, and what we're going to do is reduce that by the 30, because it's kind of like, one way of thinking about this is it's like a mini little kind of income and expenditure for, okay, well, what is your kind of total almost profit or loss from non-trade loan relationships? Now, of course, we had interest receivable of 10 and interest payable of 30 to get us to a loss on our non-trade loan relationships of 20. So again, that's just going to be a really, really important thing to learn, so that again on exam day, on those scenario questions where you get thrown these different examples, you can kind of pick them up quickly in the question and either handle them where you say, actually, okay, well, this is a trading loan relationship, so my adjustment is nothing, or actually this is non-trade loan relationship, so I need to remove that interest payable and put it into my non-trade loan relationships. So then once you've kind of got to, your adjusted trading profit, that 335 is going to go up into your corporation tax pro forma. And then what you are left with is your total taxable profits. And then you're going to, if and this is more applicable for those multiple choice questions, if you then get asked, okay, well, what is the corporation tax liability? It's just going to be the total taxable profits times by 19%. So quite simple in terms of arriving at a corporation tax liability, because again, like we said, you don't have any of the kind of bans or the personal allowance or anything like that we saw for the individuals. So we obviously kind of touched briefly on kind of gains and profit or loss on disposal, and we kind of went through like a little working for that. Now, where this is more than likely going to be examined in terms of actually can you calculate a chargeable gain is going to be those multiple choice questions. Tends to come up when it comes up with those scenario questions, they will more often than not just kind of give you the actual gain number. But as we saw, it's not a hugely complicated calculation in terms of arriving at that chargeable gain. So we'll have a quick look at an example question now. So the question we'll look at is this one. ABC Limited purchased a building for investment purposes in January 2019 for £275,000. Repairs were carried out at a cost of £40,000. An extension was added to the property costing £100,000. And finally, the company sold it in October 2021 for £535,000. The question is, what is the gain in ABC's limited corporation tax computation for the year ended 31st of December 2021? So, of course, what we first of all need to do is to pick up the proceeds from the question. So we can, of course, see that we were given that in the final sentence, the 535. It's then a case of asking ourselves, okay, well, what's going to be going against those proceeds as a deduction? Well, the first thing we know, we're going to have less the cost of the asset. So therefore, it's going to be the 275. And then what we just need to ask ourselves is the final two aspects we've been given in this question, the repairs and also the extension, are these enhancement costs, are these capital in nature? So the repair costs, by their nature, they're just repairing the property. They're not actually an improvement. They're not enhancing that property in any way, shape or form. So therefore, those repair costs wouldn't form part of our allowable costs. It's only, remember, those capital improvements. So essentially, the only other cost we have here would be the extension cost of £100,000. And this would then get us to our correct solution, the answer to this question, which is 160,000 D. So of course, the remaining three are arrived at through various different ways. You can either have considered the £40,000 for the repair costs, and then you arrive at A. Of course, we've just discussed why that's wrong. One of them is if you don't even bring in anything for these allowable costs. And finally, one is if you just bring in the repairs and not the extension. So just always be mindful of the types of allowable costs that you can bring into a chargeable gain calculation, because realistically, that's probably where they're going to make those exam questions tougher, because the actual principles of the working, going proceeds less the cost of the asset, is quite a straightforward one. So, of course, what you could also be asked for, and we didn't get asked it in this particular multiple choice question, but we could have been asked, well, what is the actual corporation tax liability? Now, remember what we were saying, corporation tax is just a flat rate of tax at 19%. So essentially, you're going to take your chargeable gain and multiply it by 19%. You're never going to start kind of applying the bands or applying the annual exemption. That's individuals and capital gains tax. This is a company and corporation tax at a flat rate. So just bear that in mind, because hopefully when you spot that in the questions, it becomes quite a straightforward calculation, as you've just seen. So what we'll move on to now, and I've kind of mentioned it before, is that, of course, depreciation is disallowed for tax purposes. And what it is replaced by are capital allowances. So we saw the depreciation is added back. And at the moment, in our example, we kind of had no deduction for any of that capital expenditure that was incurred in the year potentially. And this is what capital allowances handle, where a company gets relief essentially against their taxable profits for any capital expenditure. Now, capital allowances for corporation tax work again in the exact same way as what we saw for the trading income. There's no kind of capital allowances for sole traders, capital allowances for corporation tax in terms of the mechanisms and the working. So it's going to be the same things. Your tax written down value. You're going to have your different pools, but probably the most fundamental difference, and it goes back to what I was saying at the start, is there's going to be no adjustment for any private use of those assets, because as we've said, the company kind of can't get in and use the car. The company can't drive the car anywhere. If the company has incurred the cost of any asset and their employees are using it in a personal capacity, that's kind of the issue for the employee. The company has incurred the cost in full to kind of remunerate their employees. So the company still gets the full deduction for capital allowances because the company itself hasn't used that asset in a private capacity. Now, that said, that's probably one key difference between individuals' capital allowances and corporation tax. And the second one is actually a new tax rule in the current year, and it's known as the super deduction. So it forms part of your first year allowance of qualifying assets, So quite importantly here, though, this doesn't apply to cars. But what this kind of super deduction means is that, let's say you as a business incurred a cost of £100,000, you actually get 130% of the cost of that asset as your allowance. So of course, if you incur a cost of 100, you're going to get an allowance of 130. And then what that allowance is going to do, just like we saw for individuals, is you then kind of have your capital allowances and reduce your total taxable profits by your capital allowances. So other than the super deduction and the no private use pool, there is no difference between how you work out your capital allowances for corporation tax and individuals. So you're going to have tax written down brought forward, you might have disposals, you might have balancing charge or balance allowance, you're going to have your WDAs at 18%, and then you're still going to kind of get your tax written down values carry forward. So the key fundamental difference there, though, or thing to kind of again remember, is if it's a corporation tax question, you're going to use that super deduction. That super deduction is not available to sole traders. So we've obviously kind of worked through a relatively simple example here in terms of going from like accounting profit to taxable profit. Now, the other thing we need to consider is when are companies actually going to pay their corporation tax? Because again, what we saw with individuals was that they were kind of dictated and governed by the tax year. You know, when we worked out what would go on their tax pro forma, and we then say, okay, well, your tax liability is going to be due on the 31st of Jan following the tax year, and then you might have to make payments on account and all sorts of things like that. Now, this is where corporation tax, again, is very, very different to income tax for individuals. So the tax year, 6th of April to 5th of April, is really quite irrelevant for corporation tax. What is actually going to drive everything for corporation tax is two things, really. Firstly, and probably the biggest and most important thing, is the size of that company. And that's going to be, and we'll move on to this in a second, that's going to be dictated by the profit levels of the company. And then secondly, the actual financial year end of that company. So where a company then decides its year end, that year end then drives all of the payment dates that we'll see for corporation tax. So kind of very, very different to individuals, where of course an individual sole trader could have any kind of year end or report, that they wanted to prepare their accounts, but the tax that they were going to pay was always kind of we worked out the profit that would go on their tax return in a particular year using the basis of assessment. That doesn't happen for corporation tax. Corporation tax is, like I was saying, based on the year end, and then secondly, the size of the company. So what we have are some thresholds. So there's kind of three key thresholds and these are in your tax tables, but again, like kind of all things with principles of tax, these might start to stick in your mind by exam day. So you could either be a small company where your augmented profit is below 1.5 million, and we'll come on to what the augmented profits mean shortly. You could then be, of course, large, which is 1.5 to 20 million, or very large, which is over 20 million. So the term augmented profits, because what you're going to be doing is comparing your augmented profits of the company to these thresholds. Now, what we saw before was, of course, we worked out our kind of total taxable profits. And one really key thing was we said that the dividends were exempt from corporation tax. So of course, these numbers here don't include anything for this £500 dividends that we had. Now, the first thing we do in arriving at our augmented profit is we are going to take our total taxable profits. Of course, from earlier, what we had was 215. And we are then going to add on to this the dividends. Because ultimately, what we've had previously is, of course, we've reduced that dividend figure from our taxable profits. We've said it's exempt, so it's not actually taxed. We've kind of made no account or consideration for the dividend income. in anything up here, where we work out our taxable total profits, and also, we've taken it out of our trading income profit as well. So what we're going to do in arriving at our augmented profit is we're going to add in the dividend income to give us a total augmented profit of 715. Now, what we're then going to do with that 715 is compare that 715 to the thresholds. So, of course, we can see here that this company is quite clearly a small company. So, therefore, the payment date for corporation tax is going to be 9 months and 1 day after the accounting period. Now, one thing you can see in some of the scenario questions is actually that there might be some, it might tell you there's kind of two related group companies. Now, where you have related group companies, what you need to do is divide all of these thresholds by the number of companies. So if we've got two related group companies to the company we're dealing with, we've got 3 in total. So therefore, for kind of determining whether this company is small or not, or large, we're going to divide that 1.5 million by 3. So in that setting, of course, we're going to then, with our numbers, we would actually exceed the limit of becoming a small company. We're now in that large company, assuming we were large last year. So therefore, the payment date for corporation tax is going to be the 14th day of the 7th month from and importantly, the start of the accounting period. So it's always worthwhile, with these rules. Some of them you may end up just remembering by exam day, but it's probably always worthwhile utilising that tax table, even if you're really confident on it on exam day, to just have a double check. Have I got this right? Is it the 14th day of the 7th month, or is it the 3rd month? If it's a very low, just double checking those things. So we'll take a look at a scenario question now. So we've got in this question XYZ Limited, and the requirement is going to be to calculate, compute the taxable total profits for the year end 31st of December 22, entering a number in each relevant box. An amount is not taxable or an adjustment, you must enter a 0 into the relevant box. That's important for when you're coming to do your answer sheet, remembering that where it's a 0 or exempt from tax or whatever you determine, you need to make sure you actually put that 0 to get the mark. So what we get told is XYZ Limited is an unquoted trading company, and it prepares accounts to the 31st December and has 2 related 51% group companies. So this first sentence, that related group companies isn't wholly relevant for this first part of the question. When we move on to that second part of the question, it's where it's going to become a lot more applicable for that part of the question. That's probably the only form of overlap between the two parts of these corporation tax scenario questions. The next sentence then goes on to tell us the draft accounting profits for the year ended 31st December 2022 are 1.75 million. The following items have been added or deducted in arriving at the draft accounting profit. Now that's a really important point to have picked up on in this question, because essentially that's going to dictate how we treat these items, because remember, they have added or deducted already. So where we think something's an add back, we will add back disallowed for tax, we will put a positive number. If we deem it kind of allowable for tax, we will put a 0 in those boxes. So the first one we've got, and I would suggest come exam day, just working through each one of these in turn as they come to you. There's little point in kind of reading through the bulk of the question and coming back. Each point is really in isolation of each other. So the first one we've got is depreciation. So depreciation of £65,000, that is always a disallowed cost for tax purposes. So the first thing we can do with depreciation is put it in as a positive. We can also drop in our draft accounting profit, as per the question, and put in our add back for depreciation. And we can see, like in the answer pro forma, capital allowances is something we're going to need to work out. So remember, depreciation is always disallowed, but what it's replaced with is capital allowances. The next one we've got is loan interest payable for £12,000, which is linked back to a note. So the note we've got is interest payable is on a loan to acquire an investment property. So the term investment property straight away means that this interest that the business XYZ Limited has incurred is a non-trade loan relationship. Essentially, it's not linked to their trade. It's linked to investing activities. So the first thing we need to do is to add back that £12,000 because it's a cost that shouldn't be going into our trading income workings. Where that £12,000 cost should be going is up into our non-trade loan relationship box. Now, as this is as a cost, it's going to be essentially a negative number up here. We've incurred this interest. So one way of like viewing this non-trade loan relationship box is like a mini kind of income expenditure number for kind of like what's the total amount in relation to your non-trade loan relationships. The other thing to maybe think about is kind of you're going to do the opposite to what you did down here. So here we had a positive number, so therefore we'll have a negative number here. The next one here is property income. So we get told, property income relates to an investment property. As you kind of expect, the property was rented out from the 1st of July 2022 for £6,000 per month, payable in advance. Due to financial difficulties, the tenant paid the rent for both November and December late in January 2023. So the first thing we need to do with this property income, because of course it relates to property income, it needs to go into the property income box, is the first thing we can do is remove all amounts relating to property income from our trading income section. So again, what we'll have here, as this was income, remember we got told in the question they've added or deducted these amounts. So previously this draft profit had the property income. We need to remove that property income. And then it's not quite as straightforward as just doing that, because we need to apply the specific rules to property income. Now, property income for corporation tax is done on an accrual basis. So essentially, what we need to do is determine like how many months in the year and therefore how many months we should be accounting for the property income. So of course we can see that it's been rented out from the 1st of July through to our year end being the 31st December. So that's of course 6 months. So what we need to do is have property income of 6 times the £6,000 rent, 36,000. It's not relevant really in terms of arriving at taxable total profits for corporation tax, the fact that the tenant was in financial difficulties and didn't pay November or December. We're going to base our property income on the accrual basis. It's just a specific rule to remember for property income. So the next one we've got is qualifying donation of £16,000. So again, we've got a note linking back to this. So we've got the qualifying donation of £16,000 in the account is made up or comprises of £9,000 paid during the accounting period and an accrual of £7,000. The accrual was paid in January 2023. So again, the first thing we need to do with this qualifying donation is remove in full that qualifying donation from our trading income working. So we're going to have a positive. Essentially, we're saying it's not kind of an allowable cost at the moment against our trading income. So we're going to have a positive add back here. And then what we just then need to do is to determine what number, the correct number, should go into this qualifying donation. Now, qualifying donations, the relief you get is on a cash basis. And by that, what I mean is you're only allowed a deduction against your taxable total profits for the amount of the qualifying donation you've actually paid in cash. So, of course, we can see the wording of the question. We've got £9,000 paid during the accounting period and an accrual of £7,000. So essentially the deduction XYZ Limited is allowed is £9,000 for the cash they've actually paid. Now, of course, when in Jan 2023, when they actually pay that £7,000 as the accrued amount, that will be, eligible in the year to December 23 as a relief, as a qualifying donation in that year. So we're only going to be picking up the cash number here for the qualifying donation. The next one we've got is bank interest receivable. So we've got £4,000. Now, bank interest receivable will always be like a non-trade loan relationship. The only time it would ever be like a trading loan relationship, that would be if like the question gave you an example of like that the company is like a financial institution and generating income from it in the form of interest is their trade, which is very rare and probably won't happen on exam day. So you can kind of always be confident that bank interest receivable is going to be a non-trade loan relationship. Like I just said, you've always got to read those questions carefully though. But what you need to do where you spot that it's a non-trade loan relationship is essentially remove it from the trading income, and then we're going to allocate it to the non-trade loan box. Now, this is income, so we're going to have a negative down here because it previously was a profit, income increasing our accounting profit. So we've removed it from there. Now, what we then just need to do for our non-trade loan box is to have income of £4,000 to get a total non-trade loan relationship of £8,000 cost, essentially, or negative 8,000, because you had a cost of 12 and income of 4. So again, like I was saying, that's almost like a mini income expenditure for your non-trade loan relationships. And then finally, we've got dividends. So dividends are exempt from corporation tax. So what you're going to have here is a negative 25,000 there. And then importantly, what you're then going to put in here is a 0 because it's exempt. That's just something to remember going forwards for corporation tax. Dividends are just exempt from corporation tax. We then get told, in addition, the following items have not yet been included in the accounts. So we've got a staff Christmas party was held costing £2,000. 15 employees attended. So the rule for kind of entertaining is that any staff entertaining is in fact allowable. It's only third party entertaining that's disallowed for tax purposes. So therefore this 2,000 is going to be an allowable cost for tax purposes. We're going to have it as a deduction. And again, remember the kind of underlying accounting treatment of this was it's not yet been included. We've deemed it to be an allowable cost. So therefore we're going to have it as a reduction against our accounting profits because there's been no adjustment or account of it in arriving at this draft accounting profit. And then finally, we get told the company purchased computer equipment costing £80,000 on the 1st of December 2022. The tax written down value on the main pool at the 1st of Jan 22 was £12,000. So the first thing we can do is like pull together like a very quick capital allowance working. Of course, this is capital in nature, computer purchase, and also tax written down. It's all in relation to our capital allowances. So we've got tax written down value of 12,000. We've then got additions in the year of 80,000. And it's then just a case of going through your kind of mini checklist for capital allowances in the sense of what is that asset going to be eligible for? Is it the first year allowance? And specifically for corporation tax, is it therefore going to get the super deduction? If it's not, is it then going to get the annual investment allowance? And then if it's neither of those two, do we just get our usual written down allowance? So because this is computer equipment, it's been incurred in December 22, this is going to be subject to the super deduction. So the cost of the asset is going to be multiplied by 1.3 because we're going to be entitled to 130% of the cost of the asset as a deduction for capital allowances. The final thing to then just do would be then with that tax written down value brought forward, you're going to get your WDAs, your writing down allowance at 18%. So that's our first year allowance, super deduction, to give us a total capital allowance that's going to be, and this is kind of the final important point, this is a deduction against your trading income that's going to go in being the sum of those two. And then what you do to finish off this question is to pull in your trading income in the trading income box and have your total taxable profits there. So then the next part of the question goes on to talk about, and essentially we're now in the 31st of December 23, and what this question talks about and requires us to do is to state the first date by which any corporation tax should be paid in relation to the year ended 31st of December 23. We've got to input our answer in date, month, year format. So what, of course, we need to do, and I mentioned this at the start, is we need to carry across this information into the second part of the question. So we just need to have, like, when we first read these questions, you need to make like a mental note of how many related companies, and we've got 2. So where we've got 2 related companies, we've also got XYZ Limited. So actually, the total companies that we're going to use is 3, because we've got 2 related and the one we're dealing with. Now, what we need to do, and we'll come back to that number in a second, the first thing we need to do is just calculate the total augmented profits of this company. And this is where we get the information here. So we've got, in the year ended 31st of December 23, XYZ Limited expects taxable total profits of 1.225 million. So that number can go straight into there in our answer. And we're also expected to receive exempt dividends of 200,000 from unrelated UK companies and 95,000 from an unrelated German company. So what we then just need to do in arriving at our augmented profits is add those 2 numbers. So essentially 295. It doesn't really matter that it's from a German company. So the total augmented profits are therefore going to be 1.52 million in this question. Now, what we then just need to do is compare that augmented profits to the augmented profits threshold. So the augmented profits threshold, the first one to consider is the 1.5 million. And then kind of not too relevant, I suppose, for this question, but in terms of how we utilize this number, we then would divide that threshold by 3 because there's 3 related companies in the group. So, of course, our revised augmented profit threshold at what point we're not going to be a small company would be 500,000. So actually what we can determine is this company is a large company for corporation tax purposes, and therefore it's going to pay its corporation tax in installments. It's going to pay it on the 14th day of the 7th month. It's not going to be in that small category where it's 9 months and a day. And this is where you can refer to your tax tables on exam day to just make sure that you've got those dates correct. Now, of course, like I said, that kind of wasn't wholly relevant for this point because, of course, we already exceeded that. But what you could do, or if you've already exceeded that small company threshold, it might be relevant that actually you're a very large company. So then you need to apply the 20 million threshold. And again, you divide that by 3. Now, of course, in this question, we're well below that. So we can conclude that this is a large company and therefore we're going to pay corporation tax on the 14th of July 2023. And that's just a really important thing to utilize your tax tables on exam day. Where you deem it to be large, you then could just flick to your tax tables to make sure you've got that correct so that you ensure that you pick up your marks. So then, as a bit of a follow-up to this lesson, I'd strongly suggest working through the question bank scenario questions as well as the multiple choice questions on corporation tax, and then finally looking back over your study notes and your study manual to really make sure that you're comfortable with the underlying treatment of all the items that could come up for corporation tax and how you arrive at your tax adjusted trading profit, as well as, of course, recapping your capital allowances for corporation tax.